All right. Good morning, everybody. It's retail week um, with Home Depot reporting, Target, and then we have retail sales as our econ event for today. You can see they have an anticipated high impact. So it's something that you definitely want to pay attention to later on. We have Redbook. There's talk about strategic petroleum release purchases. Kind of gets down into the weeds a little bit, but basically when the cost of energy was really high, the White House released its strategic petroleum reserves in an effort to maybe kind of flood the market a little bit and lower prices. But they depleted their stockpiles to a record low and now need to fill it back up again. So if you're short energy, you may want to consider changing your position. I don't necessarily think that it's going to, rip to the moon. I think it's going to cap out, right? If you don't have a free and fair market with two-sided trading, then whatever the dominant buyer is willing to pay, that's going to be where price pins. So I think it's done going down, but I don't really see that it's going to, break and rally to all-time highs. Although, I mean, we are talking government. So, if anybody was going to pay 4 times what it's worth, it would probably be them. Not that I'm biased or anything. No. So we still do have a lot of Fed speakers. Mostly the drumbeat seems to be higher for longer, that they're not cutting. They're not planning on cutting. They have no interest in cutting. And until something breaks, that's going to be what they'll say. They'll say it all the way up until the moment that something breaks. The way it all works, if you're kind of new to the idea, is when inflation ran wild, they decided that they were going to begin raising rates, and their target goal was mildly restrictive rates, which means they had to move beyond neutral rates. Well, that's a hypothetical. We don't exactly know where neutral is, and we don't know how far past neutral we should go before it's only mildly restrictive and not extremely restrictive. So it's kind of a little bit of a dance of an ebb and flow, and that makes it a moving target. They don't know if they're in mildly restrictive territory yet, and the only way that they can find that out is if they call timeout on the raising of the rates and just see how much damage they've done. The data that they use to make a decision on whether or not they've broken something is really a lagging indicator. So they have to wait for old data to catch up and see where we're at. So until they break something, we start getting into a recession, companies are laying off and not making new products, and right until something breaks, they're not interested in cutting, but they also don't want to raise them anymore at this point until they have a better idea of where they're at, how far past that neutral rate they are, and whether or not they're in mildly restrictive territory or not. That makes sense, right? Sure. So a lot of Fed speakers, not just in the US Fed either. We've got European Central Bank and a lot of data coming out of the Eurozone. We got Christine Lagarde set to speak today as well, European Central Bank president. So a lot of big names and a lot of people with different agendas. The debt ceiling is becoming a bit more of a crisis, with one side now saying they don't see that there's enough time left to get something done. before Treasury runs out. Yellen's out chipping teeth. She's starting to try to freak everybody out because, well, they're still not getting any answers, or they're not getting anything accomplished. It wouldn't be the first time that things went down to the wire. If you listen to Bloomberg or other places like that, they reference 2011. So one thing that you could do is go back and look at the debt ceiling debacle of 2011. It shouldn't be hard to find on Google. You got all the keywords that you need. Debt ceiling crisis 2011, keyword search, bada boom. All right, on the week, China's done nothing. It's still inside week. But we can see yesterday, it was a monster run yesterday. And now they're giving back some of it. Giving back some of it is fine. It makes sense. But it needs to hold that 50% mark, right? If it doesn't do that, it's more likely going to come all the way back down. So just, a little bit of perspective. After such a big run, you have to kind of expect that it's going to pull back a little bit. It is interesting to note that it didn't try to go higher first. It just opened up and came right back down again. Really no wick up there. And if I zoom in, I'm sure I could find a little bit of a wick, but nothing that looks like these wicks back here. It's a dramatic wick. Such drama. After a massive gap up, Japan really did nothing. If we zoom out more and kind of see the bigger picture here, we are still within this range from, say, 2021, but we are nearing the top of it. This is a massive topping pattern, depending on what time frame you want to use. That was a really nice recovery, though, off of the lows, starting to form this big cup. With Buffett now over in Japan, it's getting a lot of insight, a lot of eyeballs, money's flowing over there. And remember, they changed leadership, and big changes are supposed to be coming out of Japan. Of course, everything takes time. All right, for London and Europe, we did have an inside day breakout, got into the liquidity zone and faded back out. So at this point, if we were using OCR analysis, then we have a higher high and a higher low, but it looks like we're going to get a lower close. So the dollar got above that 102.5 level that we've talked about frequently. But it couldn't keep it, and it didn't get above 3. So right now that 103 is the line in the sand that we really want to see resolved. There is a lot of history here, a lot of liquidity when we look back. So something to think about, right? When we come up into that level, we have to be able to resolve this liquidity issue. And so it probably won't be a first touch play. Right now, bouncing back on the 102, finding some support, providing a Busby, and then another attempt. Just remember, if we do get a Busby, the target, it only owes us back to the top here, 102.75 again. It doesn't owe us a breakout. Otherwise, we want to continue to watch this because we do have an inside day breakout to the downside. And catching support at that 102 makes sense. If it doesn't, and we continue to fade, that's very likely going to be gasoline on the fire for the S&P and the NASDAQ to continue to make that upward move. All right, so we're still looking at positive gamma, and in positive gamma, you sell into strength, buy into weakness, and you anticipate range bound markets. If we were in negative gamma territory, then we would expect to sell into weakness, buy into strength, and have an expansion and a trend. Here's your spot gamma levels for the ES and the SPX. If you want to catch a screenshot. Notice on this vol trigger here, it's what we happen to hit. 41.22, and then reversed off of that level. And on Friday, I believe the level on Friday, this was like a combo line. Now it's large gamma. It might have been large gamma then, but we did hit one of these levels on Friday on that reversal as well. And if you look at Thursday, reversal off the level as well. And on Wednesday, reversal off the level. So, you know, having the lines on there, got another one here, kind of provides a little bit of insight. Yeah. At the very least, you could see price moving in that direction and prepare for a trade opportunity, not knowing, you know, are we going to bounce there or are we going to go through there, but preparing for a bounce and or preparing for the move through, because you can see some lines it went right through and other ones is where it turned. So, you know, yeah, it's not about winning every trade. We're not trying to keep score on wins and losses. It's about losing less and winning more. Something that I think a lot of traders continue to forget. You get too hung up on winning, never taking a losing trade, which is a fool's game. We had a nice expansion this morning through the kill zone. Kill zone is between 2 and 4 a.m. And then at 5 o'clock this morning, 6 o'clock this morning, depends on your time frame, right on the dot. So another example of why I continue to say, watch the clock. I'm not, there's no hidden meaning to any of that, right? Literally just look at what time it is. If you're near a new hour or you're near a new half hour, Prepare for something different. It's very often when we get reversals. It's very often where we get big volume. And if you're trading in a small account and you're using a tight stop and you get in right before a new hour and then it wicks you out and runs away without you and you cry about it, look at the clock. It wouldn't have happened. Volume is really light this morning. And even with those moves that I pointed out, we are still range bound. We don't have an MDP, and we continue to interact with the weekly pivot point. We've crossed through it yesterday and again this morning. Sitting at 78 implies that there's a threat on the table that the market is wanting to identify before participating. Of course, we already know we've got econ on deck with retail. So we got industrial production, business inventories, 4-week auction, 52-week auction. We've got a lot of things on the agenda today, and all those speakers, right? Including Christine Lagarde. And she is, she's pretty sassy. I like it. If you haven't heard her banter with reporters that ask stupid questions, I think there's a highlight reel on YouTube you can get. I'm a nerd, I know. It's okay. 10-day, 30-minute volume profile. We are still hugging the point of control. This is beginning to get a little bit ridiculous. The longer that we maintain inside of this zone, the bigger the breakout is likely to be. I know that is going to perk up a lot of ears. When's it going to break out? Which direction is it going to go? How far is it going to go? That's not the way things work, right? It's not the fact that you can't answer it because you're lacking in the knowledge or experience to be able to answer it. It's the fact that those aren't answered. Those aren't questions anybody can answer. We are nearing the apex on this wedge. Very seldom, very, very seldom do we actually get all the way into the tightest spot. So generally the way I look at it is if I draw a wedge and I find price inside of that little area, then I drew the red wedge wrong and I delete it or I reevaluate it and re-examine it. That's my approach. Because price is not supposed to go there. And so if I draw it and I find price there, then I drew it wrong. It doesn't belong and I'll take it off. There's no wrong way to do it when it comes to analysis, but the right way is to be consistent in whatever it is that you do. So, you know, if you don't normally take it off, then don't. But otherwise, the t-shirt is true. We can't stay here. We got to get out of this. The red boxes very clearly highlight the high and the low from Wednesday. Right now, that's the ceiling and the floor that we have to resolve. We have a pretty good size air pocket below us. Just keep in mind, whatever we hit down here, it wasn't the S&P that hit something and turned and bounced back up. It was something correlated with the S&P and strong enough to move the S&P that hit something and caused this to rebound back up. It's been a while since we've had a 5-day, 5-minute, a 5x5 that looked like this. That's pretty nasty. In a situation like this, if you're marking out your daily open, high, low close and your weekly open, high, low close, you probably have lines all over the place and are choking on levels. You just have so many of them. I get it. When you're trying to get better at using pivot points and you're trying to mark them all out, and what I would recommend is work on the ones closest to you. So yesterday and then Friday. I wouldn't really struggle with last Thursday, Wednesday, Tuesday, Monday, all of those, right? Unless they are higher than Friday, right? So say Thursday's high and Wednesday's high. I wouldn't worry about, Thursday's close or Thursday's low. Mainly because we've already passed through those zones multiple times and they've lost their appeal. They've also, if they were marking any sort of liquidity, well, it's been resolved, right? There's no unfinished business, anything like that. So I wouldn't stress or waste my time marking out, all of these intraday pivots. Just stick with yesterday's intraday pivots and then start focusing on these highs and that low. We've gone sideways long enough now that we've got the 10-day with us and the 10-week. So the 10-week is at 41.20, right? 41.19, 41.20. And the 10-day is at 41.40. We tagged it already this morning in that wick drop. We crossed through it a few times this morning. So if we can get through the 10-day, we'll focus on the 20-day below it at 41.36. Below that, focus on the gap and the Globex open from Sunday night. Then the Globex low of Monday and the RTH low of Monday. Right now, all the 4-hour moving averages are all bundled together, so they're not really providing a lot of help. Probably just want to keep your highest one, like the 200. And we are negotiating with that 4-week. That's kind of a big deal. If we can get above the 4-week, we very likely got a strong rally in place. 4 weeks above the 10-week, so that's bullish. If we can now rally out beyond the 4-week, then we have a bullish surge. Right, so these deep levels, these dark red lines are the spot gamma levels on the SPX. And you can see from Friday the 5th, we've been maintaining inside of this really tight range, 4150 down to 4000. It's a 150 point range. We're just tightly wound up inside of that. This is the level that we need to break. But until we do, you want to continue to focus on selling the highs and buying the lows. And just keep in mind, the strat will tell you that the megaphone pattern is going to very likely come into play first before we finally break this range, right? We usually start out with a rectangle, then price starts to wick out on each side of the rectangle. It widens everything out. You get a megaphone, and then finally you get the move. So just because we get down to the edge and we wick out of it or we go below it, don't believe that it's the one yet, because we very likely could just rally right back in again. Same thing with the top side. All right, Apple's basically unchanged this morning. Got a whole lot of nothing. But we do on the weekly have a reversal candle. So we're still looking for that to play out. We need to break below last week's low for a nice short play. Just keep in mind, we had a reversal candle here too on the weekly, and we broke below it on the weekly. But then we rallied back up and closed above it. So we had an outsized bar, right? Bullish engulfing bar after that indecision. If we measure the last big bar, the open of that bar, 169.31, is the 50% level. So if we break out of last week's low, 169.30 is going to be where you're going to want to lock in some of your gains, right? You don't maybe necessarily have to get out of the whole trade, but it's very likely going to find support there. And if this remains bullish, then this inside week breakout is just going to be a little bit of a pullback before it continues to the upside. If we do manage to get through that level, then we'll focus on getting back down to the gap close. But all of that buying really stands out. And there is a gap to close at 165.74. All right, Microsoft is slightly up this morning, slightly. Looks like 312 is the line in the sand to the upside. And 304.25 is the level to the downside. Now there's a lot of buying that continues to take place when we get into this zone here. So we really want to focus on that. And we need an inside week breakout. This also last week gave us a bearish bar. So we're looking for a resolution of that bearish bar, a breakdown from here. 304.27 will be the first short target that you want to focus on. You could look to start that short if we break below the close of the previous week, right? Call it 309 for some easy math. This one as well is showing compression. If we use OCR analysis, higher highs. We were getting higher lows and higher highs. Now we're just getting these higher lows. And so far, a higher close. So a break out of the top side, a break above 310 should offer us a $2 move to 312. Then we'll negotiate the high of that red bar, 313. All right, nice recovery on Amazon yesterday. A whole lot of running around and didn't get anything done. It gapped up. So from the close there to the open here, did some running around, barely wicked out of yesterday's low before rallying back up and closing basically where we opened on the day. So like a hamster on a wheel, a whole lot of work and nothing for it. This morning it's down. So it closed at 111.20 and the bid and the ask are showing 111.7, 111.4. So we're slightly down. We are right now basically at the open of 511. Today we'll make this an IX10. Yesterday it was just an inside day. So after the close today, if we're still inside this, then we'll be in an IX10. We're still inside this weekly level. So a nice short. Say if we can get below the close of last week. And a nice breakout if we can get above last week's highest point. That's a big if because there is liquidity here. Last time we came up and hit into that liquidity, it sold off. All right, Tesla's still got a really big gap at 180.59. We are up this morning mildly from where we closed yesterday, but not by very much. 166.70-ish. So we're still going to be opening inside of this bar. What I would be focused on this morning with Tesla is if we can open higher than where we opened yesterday, which would give us a pivot point and maybe a support level. That way, after the open, maybe we fade down, bounce on support, get our inside day breakout, focus on 50% of that red candle and target the open of that red candle at 176. That would be my play. But that's assuming a lot. One, that we can rally up and get above the open of yesterday before the bell. Otherwise, once we're in the RTH, we have to run up and negotiate with that level, get through it, and it'll be a resistance to get through rather than a support to help us. On the weekly, we've got a really narrow candle compared to a lot of the other weekly charts we've been looking at this morning. So first things first, we got to get back inside that box, which, you know, we're kind of getting there. We're at 166.80 now. So it looks like we're back into the box, even by a minor amount. We're starting to get a TRB set up here on TLT. If you don't want to use TLT, you could use like ZB, ZN, ZF. All right, we're sitting at 3.5% on the TNX. At least that's where we closed. You can use the futures since TNX isn't open yet. So we can see that 10-year making a move back up. All right, so yesterday I mentioned, keep your eye on the bonds, the dollar, and the 10-year. Because they would probably be more insightful and more helpful than trying to use anything else. It's going to be the same thing today. If we're going to break this range that we've been in, we need a catalyst, right? We need something to galvanize the market and really get it in gear and get out of this zone. The thing is, there by this point, there's so much open interest on each side of the range that no matter which side we break, we're very likely going to reject off of it at least once before we finally make it through there. And in fact, we could actually just break both sides. It would be that violent. The follow through is going to come from something like the bonds, the dollar, 10-year. We are rallying back up again this morning after fading off in the overnight hours, going to retest these highs, the 3.5 area. The dollar also, after a nice muted day yesterday where it really didn't shake things up, it continued to fade, and then now it's starting to make some big moves down and up. So we had a move through the kill zone between 2 and 4. And now as we near the open on the dollar, it's getting ready to break out of or give us a Busby here. Busby failed, so it's already back up inside the zone. The dollar's getting rowdy this morning. Just those big sweeping moves, even if we don't end up actually going anywhere, the speed and the pace of the rate of change can drastically alter the S&P and the NASDAQ. So we still have that 102.75 from last week, or maybe from Sunday night. We'll focus on that as the line in the sand to get through. Once we can get past this pivot in our own Globex, 102.5, just for an easy number. Hell no, I better not do that. Let's narrow it in. 102.57. If we can get through that, then we'll target 66. And then 102.73. So yesterday, bonds really didn't give us much. And we didn't see much reaction out of the market, right? A sideways dollar, sideways bonds. We had a sideways 10-year. The entirety of the market with these tools were all sideways. And yet there was some really big movers yesterday in equity names. So it's not like nothing's moving around out there. I was going through the high-low graph bullish names yesterday afternoon, and every one of them was these big bullish expansions through the whole of the trading day. Really beautiful setups. So great names, great big moves yesterday. All right, makes sense. After the run yesterday, biotech is pulling back a little bit this morning. Bitcoin, China ADRs, gold, emerging markets, all down this morning. And those were the ones moving yesterday. So it makes perfect sense, especially after the size of their move yesterday. the weight of Home Depot is being accused of taking the Dow down this morning. But it's still holding the lows set from last week, and we're nowhere near them, actually. So on Bloomberg this morning, that's what they were talking about. It doesn't seem that low to me. A little weak, but we're still inside day. Here's Home Depot after its earnings release. So we got Target tomorrow. Now, Target had a really big issue with its inventory, right? Remember during COVID, there was a whole big supply chain issue, and stores like Target couldn't get enough product on their shelves fast enough. Well, of course, purchasing managers went completely overboard and bought too much crap, which then left Target with an inventory problem that it's been trying to resolve for over a year now. And I haven't been keeping up on it, so I don't know if they've resolved the issue or not, but I'd like to believe they have at this point. It's something to consider if you're looking for an earnings trade after they report, on the expectation that, maybe they're going to come out with some positive news, maybe. That kind of information is easy to find to a point. You start searching around, right? Really new stuff hits the paid services, but then within 2 or 3 days, it's no longer on the paid services. You can find it in regular news sites all over the place. If they've been making any comments or, have mentioned this supply chain issue at any point, because like I said, it might already be resolved, and I haven't been keeping up, so I don't know. If it's already been resolved, you'll find an article on it that says it's already been resolved. Maybe they mentioned it at one of their previous earnings. All right, its pre-earnings run is about 3.75%. That's a 21-day pre-earnings run up. If you are focused on something a little bit closer, since we're only 2 days away, the post-earnings average move is -4.5. So a run up into earnings of about 3 3/4, and then a 4.5% drop after earnings. That's what Target typically does, or at least that's what it's done over the last 8 earnings, which is how many earnings we're looking at on this chart. A 4.5% move from our current location. You'd be better off doing this move after the close today. $153.82. I think $7, 6 something. Considering where we are in volatility compared to where we have been over the last 3 earnings, we're really sitting at a low vol too. All right, we're sitting way down here compressed. Previous earnings, we were closer to 5. The one before that, we were above 5. The last 2 before that, 3. So, that's typically how things go. They'll overstate it because they'll have a really big move that caught everybody by surprise. And so the next couple of earnings are overstated, but then we don't get the big move and then it starts to be, less overly stated. All right, so it's pretty simple, guys. Range, we're in the range, we've been in the range. It's the same thing. Mark your levels, look for the edges, watch the clock. If you're losing more often than you win and you're struggling, quit doing the hard stuff. The hard stuff would be if we're still sitting inside of this Globex range, it's going to be difficult to trade. Now, I'm not saying that you can't do it. I'm not even saying that you shouldn't do it. Just that if you're struggling and you're losing more often than you win, then quit doing the hard stuff. That would be the hard stuff. If we're still sitting inside of yesterday's range, it's going to be more difficult than if we have an inside day breakout. So zone 1, zone 2, and of course you can take that even one step farther. With zone 3. Everybody have a good day.